Mark Newton is with us. He's the president and founder at Newton Advisors. Mark, you got some charts. Let's start with the big one, the S&P 500. Walk me through the way you're interpreting the latest move to the upside.
Hi, Albert. So there's a couple of interesting things for investors to keep on top of, and that last week really was one of the largest times of rotation that we've seen since the middle part of May, and that's important because many have been concerned about this over-concentration into tech. Now we've seen tech start to wane a bit and rotation into other groups. Things like industrials, we saw a big move in energy yesterday, and of course healthcare. Yesterday, the equal weighted financials index also was up about 2.5%. So this is a healthy sign, I think, for the market in the short run. And for the S&P, being over the June 8th highs is certainly a very constructive development. We continue to see things like the Russell 3000 also getting over its June 8th highs as being a very bullish sign because that's 98% of all the stocks. So historically, it was only the NASDAQ 100 that was making this move, and now you're starting to see more and more sectors participate. So the breadth has actually improved in the last week, and that's certainly a good thing.
So it's gotten better, right? Because we had that big NASDAQ move on little breadth, so now that it picks up, that's encouraging. I also noticed that our RSIs are not overbought. The momentum has not been really explosive. Do you view that as a good thing, where there's room to pick it up, or a bad thing in that there's not much behind it?
Well, I view it as constructive in the short run. I think that, while markets are entering sort of a seasonally negative time, I still think the pullbacks likely prove short-lived for now. There are cycles that hit towards the middle to the latter part of August. It could be a concern. But for now, it's actually been a decent development to see, those rotation out of growth into value, and really the decline in the dollar has been very, very important in helping the emerging market trade also. So that's benefiting China, that's benefiting a lot of the LATAM space, and that's a good sign overall. So the three things are really the rotation, the move out of growth into value, and really the decline in the dollar, which is serving to help commodities. We've seen these big moves in gold and silver recently, and also really helping emerging market trade.
The talk of the town over the last week is that rotation, potential for it. I can't really recall a time where we've seen this amount of drama between the NASDAQ and the Russell. It's generally just been the NASDAQ sucking up all of the equity flow, and it's business as usual. But there's a real battle going on here where it seems like you have to choose one on a day-to-day basis this past week. So, Mark, how do technicals inform analysis of rotation, either right now or just generally speaking? What do you look for to become convinced?
Well, we can see the rotation when you simply look at relative charts of different sectors versus the S&P, and you've seen movement actually into healthcare recently, which had been lagging for the last couple months. So that's a decent sign. The move in the yields, to me, is a little bit of a concern in the short run, but financials actually have acted okay. They haven't been that adversely affected. But yeah, to get back to your former question, if I could, real quick, I mean, the momentum certainly has been good on a daily and a weekly basis. Really, though, the monthly momentum still a little bit of a concern for me. Momentum peaked out in the early part of 2018. Even though markets have continued to go higher, momentum has really lagged and dropped off. So I am concerned heading into next year, given the flattening out in the longer term of momentum. I don't view this as being sort of an up and away. While markets do have a chance to really test their all-time highs, which is constructive in the short run, I think we really have to all be on guard for evidence of sentiment starting to get more and more optimistic. We have seen some signs of the Robinhood traders, obviously very, very low put-to-call ratios. That is a concern. However, the virus starting to creep back into the picture again with no vaccine, China-U.S. tension, and also, the lack of a stimulus bill. I think all those are concerns that still are keeping the investor, by and large, on the sidelines. We haven't seen this rapid joining in of this rally with the majority of investors, despite what some of the speculative indices are saying, that many people are still, to some extent, waiting for the pullback. They have not been involved in the market since March. Many of the people, de-risked at the right time, but yet, it's always very difficult to catch the bottom. And after you've missed 40%, what's in store now? So, I am optimistic into the fall, and even on a pullback in September and October, I think it's right to buy into that. But as you head into year end, there are some things that are going to hit towards the latter part of the year, cycle-wise, and of course, the election is also a big concern in terms of, a really contentious debate about what could happen. That's something for investors to pay attention to.
All right, so we're waxing some fundamentals into this technical conversation. Mark, when you look at the tension within some of the upcoming timelines, whether it's election, if it is the expiration of the fiscal stimulus and whether or not it gets extended, is there anything on the chart that offers a timeline? I know, like, sometimes we'll draw wedges and triangles and we'll say, okay, we can go into this corner of the wedge and that's a couple of weeks away. Is there any drama on the technical timeline here for the market that gives us a kind of end date by which we need clarity?
Unfortunately, many of the charts remain constructive. There's nothing for investors to look at technically based on price action alone that would give us clues to that. But I would simply, invite people to pay attention to when markets are nearing those former all-time highs with regards to, the S&P and the Dow. The transports obviously have lagged pretty substantially since the early part of June. That now seems to be catching up. The overconcentration is going to be a larger concern, I think, heading into next year. Simply, it's just very, very difficult for 5 stocks to continue to lead. But the bottom line is, if that's the market, then pay attention to those 5 stocks. Until Apple gets down under 375, there's really no reason to be all that concerned about, the big 5 starting to fall apart. And so if those trends are still intact with all these large mega cap names, and one still wants to be involved in those, even though they are dramatically overbought at this stage.
Yeah. So overbought in the NASDAQ, some of these names that have run up in a huge way, potential for rotation elsewhere. You mentioned the transports that had been lagging, now trying to take part in this rotation. The financials are also kind of a bellwether for gauging new sectors performing. How do those look to you, Mark?
Well, the financials have still been under pressure, relatively speaking, for some time. Treasury yields peaked out the early part of June, have been really on a steady downtrend ever since that over the last month and a half. So, it's been difficult for financials to really assert any sort of leadership. Yesterday could have been important in that regard and showing that, banks are starting to have a little bit of a nudge higher. And so, I am optimistic, but you really have to be selective in terms of what to own in those groups. I tend to like the exchanges. I tend to like, just different parts of financials necessarily than the large banks. I think that are the credit card companies, if anything, they're a big COVID play. Nobody wants to go out in public and use cash these days. Everybody's using, Venmo, they're using credit cards, and that makes a world of sense to me. So, for me, it's the credit card companies like Visa and MasterCard that I like a lot. And, just looking at some of the different parts of financials rather than just owning the big banks.
Mark, what's the best looking chart out there to you now? I'll hit you with one more before we go. If you had to pick one, what's the most compelling?
Well, a lot of it depends on your time frame. So, longer term, I think the move in the metals is actually quite bullish with regards to what's happening in silver. Things have gotten very extended, and I've talked to clients about reducing their exposure to silver in recent days. It's been a fabulous run in the last month and a half. But on an intermediate term basis, I think that the move in silver is very interesting. We've gotten over 2016 highs, and this is part of the larger movement, I believe, back into the commodity space as yields are low and we're seeing a decline in the U.S. dollar. So that's all very optimistic for commodities. I do think that commodities should be a piece of investors' portfolios heading into next year. And so charts like the DBC for the larger ETF that governs the commodity space is something I'm taking a real look at in terms of putting money from large cap technology into the commodity space. In the short run, I think the move in healthcare has been one of the more optimistic. That's a great looking chart on a short-term basis. You look at daily charts of XLV, the movement in the medical devices space and IHI. Those are all constructive and should help this group to continue to move up into August. July tends to be a very bullish month for healthcare in general, June and July. We have seen that break out to new all-time highs in XLV. So I think we get up to right near 109, 110, and investors can invest in healthcare and really use dips to buy pullbacks.
Mark Newton, always good to have you here. Thanks for your thoughts on the technicals. We'll be keeping our eyes on the metals. Silver joining the gold party. Mark Newton, president and founder at Newton Advisors.